This episode is brought to you by Google Chrome. You think you know a browser, but Gemini and Chrome? That's new. It can help you with practically anything on the web, like restoring a vintage motorcycle from a 50-page restoration blog, or finally break down that long article you've had open for weeks. Gemini and Chrome is here for it. Ready to make anything online make sense? There's no place like Chrome. Check responses, setup required, compatibility and availability varies, 18+.
When you need to build up your team to handle the growing chaos at work, use Indeed Sponsored Jobs. It gives your job post the boost it needs to be seen and helps reach people with the right skills, certifications, and more. Spend less time searching and more time actually interviewing candidates who check all your boxes. Listeners of this show will get a $75 sponsored job credit at Indeed.com/podcast. That's Indeed.com/podcast. Terms and conditions apply. Need a hiring hero? This is a job for Indeed Sponsored Jobs.
Welcome to Learn Finance 101s, where we break down the key historical events within finance and economics. The global financial crisis is a pivotal moment in modern economic history, one that reshaped the global financial system and left lasting scars on societies around the world. To create a more in-depth version, let's delve deeper into the origins, mechanics, key players, timeline of events, policy responses, and long-term consequences. We'll explore not just the facts, but the human stories, the systemic failures, and the lessons that still resonate in 2026. Let's start by setting the stage with the long prelude that led to the crisis. The roots of the 2007 to 2009 meltdown can be traced back to the deregulation wave of the 1980s and 1990s. In the United States, the savings and loan crisis of the late 1980s had already exposed the dangers of lax banking oversight. But instead of tightening regulations, policymakers pushed for more liberalization. The Gramm-Leach-Bliley Act of 1999 repealed key provisions of the Glass-Steagall Act of 1933, allowing commercial banks to engage in investment banking activities. This blurred the lines between traditional lending and high-risk trading, creating behemoths like Citigroup that could take on massive leverage. At the same time, the Federal Reserve under Alan Greenspan kept interest rates low after the dot-com bust of 2000 to 2002. The federal funds rate dropped to 1% in 2003, the lowest in decades. This cheap money encouraged borrowing, particularly in the housing market. Home ownership was promoted as the American dream, with government policies like the Community Reinvestment Act encouraging banks to lend to low-income neighborhoods, and Fannie Mae and Freddie Mac buying up mortgages to provide liquidity. The housing boom really took off around 2002. U.S. home prices rose steadily in the 1990s, but from 2000 to 2006, they surged more than 80% nationally, according to the S&P/Case-Shiller Home Price Index. In hot markets like Las Vegas, Miami, Phoenix, and parts of California, prices doubled or tripled. Why? Low interest rates made mortgages affordable. Lenders relaxed standards dramatically. Subprime mortgages given to borrowers with poor credit or low income grew from 8% of originations in 2001 to 20% by 2006. No-doc or liar loans required little or no income verification. Adjustable rate mortgages, ARMs, offered low teaser rates as low as 1% that later reset to higher levels. Home equity loans and cash-out refinancings let homeowners borrow against rising property values to spend on vacations, cars, or more investments. Financial innovation turned this lending frenzy into a global time bomb. Banks originated mortgages but didn't hold them. They sold them to Wall Street firms like Goldman Sachs, Lehman Brothers, and Bear Stearns. These firms bundled thousands of mortgages into mortgage-backed securities, MBS, and sold slices to investors. To make them more appealing, they created collateralized debt obligations, CDOAs, complex securities that repackaged MBS tranches into new layers, with senior tranches rated AAA by agencies like Moody's, S&P, and Fitch. Credit default swaps, CDS, insurance-like derivatives sold by companies like AIG, allowed investors to bet on or.
This episode is brought to you by State Farm. Listening to this podcast instead of doom scrolling? Smart move. Another smart move? Getting help from one of State Farm's 19,000 local agents when you choose to bundle home and auto. Bundling, just another way to save with the Personal Price Plan. Prices are based on rating plans that vary by state. Coverage options are selected by the customer. Availability, amount of discounts and savings, and eligibility vary by state.
Hedge against defaults. Rating agencies played a crucial role in the deception. They used models assuming home prices would never fall nationally and that defaults were uncorrelated. Conflicts of interest abounded. Agencies were paid by the issuers they rated. Investors worldwide, pension funds, insurance companies, European banks, Asian sovereign wealth funds, bought these securities for their high yields and supposedly low risk. Banks held them on balance sheets or in off-balance sheet vehicles, structured investment vehicles, conduits, often with leverage ratios of 30 to 40 to 1. The narrative was seductive. Housing prices always rise. Home ownership democratizes wealth. Subprime lending expands opportunity. Financial engineering spreads risk, so no one institution can fail. Alan Greenspan praised adjustable rate mortgages in speeches. Ben Bernanke, who succeeded Greenspan as Fed chair in 2006, said in 2005 that U.S. housing prices were unlikely to fall significantly. Lenders advertised no money down loans. Real estate reality shows like Flip, This House dominated cable television. Daily life reflected the mania. In Las Vegas, Phoenix, Miami, and California suburbs, families bought homes as investments, expecting to flip them for profit within months. Speculators purchased multiple properties with interest-only loans. Home equity lines of credit-funded vacations, cars, renovations, and even stock purchases. Builders constructed entire subdivisions on spec, fueled by demand from buyers who qualified for loans they could barely afford. Mortgage brokers earned commissions on volume, not quality, pushing borrowers into subprime products. Real estate agents pressured clients to stretch affordability, assuring them that rising values would bail them out. The peak came in 2006. Home prices topped out in many markets. Subprime defaults began rising as teaser rate ARMs reset and home values stopped climbing. By early 2007, subprime lenders like New Century Financial collapsed under weight of delinquencies. Hedge funds run by Bear Stearns holding subprime MBS imploded in June to July 2007. The crisis spread. In August 2007, BNP Paribas froze 3 funds holding U.S. mortgage securities, citing inability to value them amid market turmoil. Credit markets froze, interbank lending rates, the LIBOR-OIS spread, spiked as banks mistrusted each other's balance sheets. The Fed cut rates and launched emergency lending facilities. Northern Rock in the UK suffered a bank run in September 2007, the first in Britain in over a century, and was nationalized. Bear Stearns survived a run in March 2008 only because JP Morgan acquired it with Fed backing. The panic peaked in September 2008. Lehman Brothers, highly leveraged and loaded with mortgage securities, filed for bankruptcy on September 15, 2008, the largest corporate bankruptcy in U.S. history. Treasury Secretary Henry Paulson and Fed Chair Bernanke had decided not to bail it out, fearing moral hazard. The decision backfired. Credit markets seized. Money market funds broke the buck. Commercial paper issuance halted. Banks stopped lending to each other. The S&P 500 fell 57% from its October 2007 peak to its March 2009 trough. Global stock markets collapsed.
Tomorrow morning is knocking. Stock your fridge now. How about a creamy mocha frappuccino drink? Or a sweet vanilla? Smooth caramel maybe? Or a white chocolate mocha? Whichever you choose, delicious coffee awaits. Find Starbucks Frappuccino drinks wherever you buy your groceries.
A burst pipe, a dead water heater, the AC calling it quits. Who do you call? HomeServe is an easy way to handle unexpected home repairs with plans covering stuff basic homeowners insurance usually won't. Instead of scrambling for a contractor, you make one call to get the repair process started. Join the millions of customers who trust HomeServe right now. Go to homeserve.com/podcast for 50% less your first year. That's homeserve.com/podcast. Savings compared to renewal price. Void in Florida.
Emerging markets lost trillions. Governments and central banks responded with unprecedented force. The US Treasury and Fed bailed out AG September 2008. Fannie Mae and Freddie Mac and major banks via the Troubled Asset Relief Program, TARP, October 2008. The Fed cut rates to zero, launched quantitative easing, buying trillions in bonds, and created emergency facilities for commercial paper, money market funds, and even primary dealers. The Dodd-Frank Act, 2010, created the Financial Stability Oversight Council, imposed stress tests, introduced the Volcker Rule, mandated central clearing for derivatives, and gave regulators more tools to monitor systemic risk. Basel III raised bank capital requirements worldwide. Recovery was slow and uneven. Unemployment peaked at 10% in October 2009. Housing prices fell 30% nationally. Millions lost homes to foreclosure. Global GDP contracted in 2009, the first decline since World War II. Full employment returned only by 2016 to 2017. The Fed's balance sheet ballooned from under $1 trillion pre-crisis to over $4 trillion by 2014, then higher still during COVID. Why did the bubble grow so large? And why did it nearly break the world? Low interest rates and loose credit fueled speculation. Deregulation, repeal of Glass-Steagall in 1999, Commodity Futures Modernization Act 2000, allowed banks to expand into riskier activities. Financial engineering hid risk. Rating agencies misjudged default correlations. Leverage amplified losses. When home prices fell, the feedback loop reversed. Defaults rose, securities lost value, banks hoarded cash, credit froze, businesses cut jobs, consumers stopped spending. The aftermath produced lasting changes. Dodd-Frank, Basel III, and post-crisis reforms made the system safer but more complex. Central banks now intervene aggressively in crises. Public distrust of Wall Street lingers, inequality widened, bailouts saved banks while homeowners suffered. The crisis influenced politics. Occupy Wall Street, Tea Party, Brexit, populist movements worldwide. In 2026, the 2008 crisis remains the benchmark for systemic risk. Low rates again fuel asset prices. Leverage in non-bank finance, private credit, hedge funds raises concerns. Central banks balance inflation control with financial stability. The lessons endure. Bubbles in one sector can threaten the entire system. Innovation in finance can hide risk. Regulation must evolve faster than markets. And when trust evaporates, only decisive action can restore it. The global financial crisis wasn't just a housing bubble. It was a stress test of modern capitalism, and a reminder that no economy is too big to fail. Thank you for listening to this episode.